it's 5:30. Let's get started. Welcome, everyone. Thank you for joining me today for our live stream seminar, part 2 of the Real Estate Buyers series. Buyers, are you ready? Today's topic is about home loans and maintaining a good credit profile, as well as being proactive in protecting against identity theft. Today, we're also streaming live on Facebook, YouTube, 一直播, Weibo, and TikTok. Today, we also have a special prize for raffle drawing. Don't forget to register for this free raffle drawing. The registration form is available in a public message to everyone in Zoom. Hi, my name is Coco Tan. I'm a realtor with Keller Williams Realty in the San Francisco Bay Area. If you wish to receive the latest videos and seminar updates, please feel free to subscribe to my YouTube channel. I have a big QR code here on my wall. Our Buyers series, Buyers, Are You Ready?, continues with part 2. We take an in-depth look at home financing and credit scores. To ensure a smooth and successful home buying experience, it takes the right professionals and experts to guide homeowners, home buyers like you. Since the start of the COVID shutdown, mortgage rates have dropped to historically low levels. On July 30th, the San Jose Mercury News reported that Bay Area home prices continue to rise in June, with the soaring stock market and historically low interest rates driving big purchases in Silicon Valley. The real estate market is still going very strong. New home builders are very bullish on the market right now. Just last Friday, August 28th, a Barron's.com news article stated that many housing experts expect the market to stay strong for several more years at least. And just yesterday, August 31st, the San Jose Mercury News reported as a headline that Bay Area home prices climb on strong demand, low supply, tight inventory, and unstoppable buyers, ignoring the economic drag of the COVID pandemic, pushed Bay Area median home prices to near record levels in July. Median home prices for single-family home in the Bay Area rose 8.6%, led by a soaring prices in Contra Costa and also San Mateo counties. Many residents who live in the Silicon Valley are very updated about the local real estate market. They understand that owning Bay Area real estate is very important. In fact, one of the selling points of the 30-year mortgage is to maintain a relatively fixed cost for housing, property taxes not factored in, and enjoying the appreciation of a valuable asset class. I like having the seminars to help the local home buyers and owners to refresh and improve their understanding of home ownership. Understanding loans is such an important part of this. Many buyers chose ARMs, adjustable rate mortgages, for their starter home. Depending on the rate and your current financial situation, there are so many options to finance your real estate investments. The banks have so many programs that can be tailored to you in any kind of situation. That being said, you have to be mindful of your credit profile in order to take advantage of these loan programs. Getting pre-approved by a lender is usually the number one step in purchasing a home. A pre-approval can tell you the price range of the homes you should be shopping for. How do you get started? What are the things you need to be careful of? Today, we have an insider who will give you the tips on how to shop for various mortgage loan programs and interest rates. Joining us first is Wilson Chai. Wilson Chai is a vice president and a senior lending officer at Bank of America. He has been with the bank since 2004. Wilson is a highly experienced mortgage banker and has always been a top originator in the nation. He has completed more than 2,000 mortgage transactions in his career. Earlier in his career, Wilson was vice president, investment banking at Wells Fargo Securities, where he advised the bank's S&P 500 clients on IPO, equity private placement, and mergers and acquisition transactions. He was also part of the integration team for several Wells Fargo acquisitions. Wilson was an accountant with Arthur Andersen from 1990 to 1993. He has a master's degree in business administration from DePaul University. He also earned a bachelor's degree in economics from the University University of Chicago. Thank you for taking your time out. Are you here?
I think I lost you, Coco.
Coco, are you there? I think we lost you.
I hear you now.
Coco, you're breaking up. We no one can hear you.
Yeah, it's very choppy. Maybe your internet connection.
Yeah.
Wilson, you might have to just get started with your presentation.
Okay, I guess while we're waiting for Coco to come back, I'm just going to start my my slideshow. But anyway, everybody, good afternoon and good evening. My name is Wilson Chai, and like Coco said, I've been in the business for a long, long time, since 2004. That's when I got into the mortgage business. I actually started working for a bank back in 1988 when I was in college. So I'm very pleased to be here today and to talk about what are some of the things that I think are important when you're shopping for a mortgage. And I hope that at the end of the presentation today, you'll find everything to be valuable to you. And hopefully in the near future, when you're applying for a new mortgage, whether that's refinancing or for buying a home, I can help you to save quite a bit of money. So I'm going to share the screen right now so you can see my slides. Actually, John, I think I need Coco to give me the permission to share the screen.
Oh, try one more time. I think I did.
I got it. Okay, so hopefully you guys can see my screen now. Okay, so I want to start by talking about an overview of the market. Coco sort of briefly mentioned that, and so I just wanted to reiterate. As you know, in the last 6 months, I think started in March when this COVID thing started and we started having SIPs, the interest rate has dropped sharply. For 30-year fixed loans, in the last 6 months, we've seen the interest rate drop by 0.5% to 0.75%. I think we saw equal amount of interest rate reductions for adjustable rate mortgages. So needless to say, right now, it's perfect time to refinance your mortgage and to buy homes. Okay, we're seeing a ton of people calling in. We get a lot of phone calls, customers that wanted to get rate quotes. And we have a lot of people that are doing pre-approvals so that they can be in position to purchase homes. Now, I wanted to tell everybody that we think the interest rates can be extremely volatile going towards Q4 of this year because of the election that's coming up in November. And also, every day we get news on the pandemic, news on the vaccine developments, and things like that. It can cause the financial markets to go up and down sharply. So interest rates can change quite a bit from day to day. So my recommendation to everybody is that if you find an interest rate that you're happy with, that's going to give you a good amount of savings, and your lender is reliable, I will say just go ahead and lock the loan. Do not try to sort of take your time to think about it and then trying to procrastinate and hope that you can find an even lower rate later. Because if you don't lock right now, you might just miss the boat completely. Okay, with a lot of activities going on in the markets, with so many people that are constantly out there shopping for loans, we're seeing a little bit of a bait and switch out there. So I wanted to tell everybody that, if you're talking to a lender and if you're getting a super low quote, okay, be very suspicious of that, okay? Especially if somebody's telling you that they can give you a super low rate, that's way below all the other lenders and they can actually pay for all your closing costs. Demand something in writing to confirm that. Okay, I've seen some lenders out there giving really low rate quotes, but a lot of my customers are saying that they're not able to close down those loans. And some of the lenders, when they promise lender credits for closing costs, they're not willing to put anything in writing. So if you run into any lenders like that, I will say just move on and go to another lender. And it's extremely important that not only you get the best rate possible, you need to work with somebody who is reliable, who's ethical, and they will truly deliver what they promise you and do so on a timely basis. Some of the lenders right now, they're so busy. If you put in an application for refinancing, they will not touch your loan for at least 3 months. Okay, so just think about that. If your loan's being processed and you have to wait for 3 months before they even look at your loan, okay, during that 3 month period, you're still paying the old interest rate on your existing mortgage, and that could be a very high rate. So you're wasting quite a bit of money by waiting for these lenders. So sometimes it doesn't pay to wait for these lenders. If you can find somebody who can deliver the loan to you quickly, go with that and save the money right now. And most mortgages, especially for refinancings, are done as no fee loans, right? So take the interest rate that you can find right now and get it done. And in case if the interest rate drops later, you can always refinance again. You can do that over and over. Okay, there's no prepayment penalty for most of the loans that we do as a banking institutions. Now, if you go with a broker, sometimes they say, no, you cannot refinance for 6 months. Okay, if that's the case, then you got to be really careful with that. Okay, with large banks, Bank of America, Wells Fargo, Chase, Citibank, we don't have any prepayment penalties. So just take the interest rate that you can get right now, refinance it, and then later on, refinance again if the interest rate drops by another 0.25% or 0.375%. Okay, so now I want to talk about some of the factors that could potentially affect mortgage rates. Okay, on the left-hand side, we have those factors that are more related to financial markets. Okay, so things like 10-year Treasury bond yields, the Dow Jones indices, the S&P 500s and NASDAQs, things like the news reports that we hear on inflation, on employment figures, news that we hear every day on the COVID, on vaccine developments, and finally the international politics, the tensions between U.S. and China, the U.S. and Iran. So some of the news that are coming out of the Middle East. So those could all have a big impact on financial markets and on the interest rates. On the right-hand side, we have the factors that are more related to individual borrowers. So things like credit scores, loan-to-value ratios, the property locations. I'm pretty sure you heard of those, and I'm pretty familiar with those different factors. Now, these days for the large banks, they tend to have a lot of discount. Okay, they have discounts on the existing customers who have large deposits with the bank. They also have discounts for customers who might not be banking with them right now, but they could potentially move a lot of assets to the bank. Okay, so you can get a lot of discounts for that kind of a relationship. And so you definitely want to know about them. Some of the banks, they have contractual relationships with the larger employers in the area. So for example, at Bank of America, we have what we call a workplace banking relationship with companies like Google, Apple, Cisco, Microsoft. And so therefore, these companies' employees, when they're applying for car loans or mortgages, they can get additional discounts. So we have a relationship like that with many employers in the area, and the list just keeps growing every day. So every time when you apply for a mortgage, it always pays just to tell the loan officer who your employers are, and we can always check the list for you and then see if there's any discounts to be had. Okay, the last point I wanted to mention, which is something that most people don't realize, is that lender appetite is also very important in terms of factors on interest rates. A lot of times we get customers tell us that, you know, the market rate seems to be very low, but when they call the lenders, the quotes that they get don't seem to reflect that. Okay, now a lot of that is because the lenders that they're calling, they're too busy. Basically, they have too many loans in the pipeline, and they're struggling to process those loans in the pipeline. So therefore, sometimes they jack up the interest rates to slow down the flow, and so that they can get caught up in the back office. And once they're caught up, you know, on the processing team, on the back office processing side, then they will lower the interest rates and allow new loans to come in. Okay, so now with all these different factors that we just talked about, okay, nothing is as important as you calling your loan officers and checking the rates directly. Okay, don't just look at the bankrate.com, or don't look at the rate quotes on banks' websites, because those are not very accurate. Usually those, you know, internally we think of those rates as teaser rates. They're used more for marketing purposes, and they're based on generic assumptions. Okay, they typically do not apply to you as a borrower. So you want to talk to loan officers and tell them everything about you, so that they can give you really accurate quotes, so that you can compare the offers from different lenders and make your final choice. Okay, on this slide, I wanted to talk about the sort of savings as a result of the interest rate reductions over the last 6 months. I always like to sort of demonstrate the savings by looking at numbers instead of just sort of talking about it. Okay, so in this example, we're assuming that you know, a person's getting a mortgage for $1.5 million, and 6 months ago on a 30-year fixed loan, the interest rate was 3.75%. Now, 30-year fixed loan is 3%, and sometimes even less. Okay, depending on your relationship with the bank. Okay, so if you look at the monthly payments, 6 months ago for the same loan amount, the monthly payments was $6,946. Now the monthly payment dropped by $622 to $6,300. Okay, and even bigger savings is on the interest side. Okay, so if you look at just the interest components of your monthly payments, 6 months ago at 3.75%, that interest that you pay during the very first month of your loan would be $4,687. Okay, now if you apply for a loan for $1.5 million at 3%, during the first month, the interest component of your monthly mortgage is only $3,750. So that means you're paying $937 less on interest. That's just in 1 month. Okay, so that's even a bigger number than the monthly payment reductions from the lower rates. So that tells you how much savings you can have because of the lower rates. Now, what does that say? How does that benefit you? Well, of course, you save money, right? You pay less every month. Okay, the other thing that you need to think about is, now that you have a lower monthly payment because of the lower interest rate, you could potentially buy a bigger home. Okay, so let's just say in this example, you know, let's just say you're comfortable with a payment of $6,946 that you would have gotten 6 months ago. Now, with the lower interest rate, you say, okay, so what kind of loan can I get for that same payment? Okay, so I did some calculations. I would say approximately for that same payment of $6,946, you will be able to get a loan for $1.65 million. So that's an increase of borrowing of $150,000 just because of the function of a lower interest rate. So that allows you to be able to look at bigger homes, or perhaps homes in a nicer area, or perhaps in a better school district. Now I got an example over here for refinancing as well. Okay, so in this case, it's same thing, $1.5 million loan amount. Now, I just assume that you got this loan 2 years ago, 24 months ago. Okay, and back then it was 3.75%. Your monthly payment, is the same, $6,946. Now, let's just say on month 24, you decided to refinance to another 30-year fixed mortgage. You had 3.75 before, now you're down to 3%. Okay, your monthly payment drops from $6,946 to $6,097. So that's a reduction of $849, $850 almost. Okay, the interest component of your monthly payment drops from $4,519 down to $3,615. So that's a reduction of $903. So that's a huge savings. That's almost $1,000 of savings, and that's savings every month. Okay, so again, let's just say that you're okay with a payment of $69.46 per month, and now with the new loan after refinancing, let's just say you continue to make that same payments. Okay, if you didn't have, sorry about that. If you didn't have the new mortgage, you would just have another 28 years left to, just a second, please. Sorry about that. But anyway, so let's just say if you didn't refinance and then you have another 28 years left. Okay. Now, if you continue to make the same payment as your old mortgage with this new loan at 3%, you actually pay off the loan in 25.5 years. So that means you cut down the term of your loan by 2.5 years just by making the same payments as before. Okay, so that's how you see, the power of refinancing is demonstrated over here. Okay. Okay, let's just say that now that after hearing all of that, you're ready to apply for a mortgage, whether it's refinancing or for a home purchase. Okay, so I just want to tell you some of the important steps that you need to take so that you're ready for that. So the number one thing that you need to do before you apply for a mortgage is check your credit yourself. Okay, I get a ton of phone calls from customers asking me for rates every day. Okay, majority of the customers, when I ask them, okay, so what's your credit score? They tell me they have no clue. They don't have any idea. They usually just say, hey, I think I have a good credit score. Okay, what is that? What does that mean? They say, well, it's 700 and above. Well, to a lender, 700 and above is a huge range. Okay, because for Bank of America, the interest rate thresholds goes from 800 to 780 to 760 to 740 to 720. So basically, every 20 points is a threshold for interest rates, right? So there's so many brackets between 700 and 800 that by not knowing your actual credit score, the loan officer is not going to be able to tell you precisely what your interest rate will be. Okay. Another thing is when we're calculating the mortgage on a refinancing, we like to know what your loan to value ratio is. And that means we need to sort of know what the market value is for the property, right? A lot of loan officers, when they ask their questions, the customers don't really know exactly, or they might just give you a figure that might be, $300,000 off. Okay, so they don't really have a closed cap on the appreciation of the property, and that makes it very difficult for us to calculate the interest rate for them. Okay, so number two on the list is that make sure that when you trying to shop for a mortgage, okay, you have your credit scores, you sort of check to yourself online, and then you know what your property is worth approximately, okay? Whether you talk to your neighbors or maybe you talk to realtors like Coco, okay? Now you have your armed with information, and you can go talk to a loan officer to get some accurate quotes, okay? Now when you do that, don't just get the interest rates, okay? Ask for both interest rates and ask them, okay, so what's the cost for getting the rate, right? The interest rate and the closing costs, they go hand in hand together as the pricing for your loan. So by quoting you a rate without quoting any discount points up front or any closing costs is sort of meaningless. Okay, I can quote a rate for 3% to somebody on a 30-year fixed, or I can quote a rate for 3.5% to another person. Okay, they all have different closing costs, they all have different points. And so if you just compare without getting complete information, you're not comparing apples to apples.
So Wilson.
Yes.
So Wilson, maybe it's a good time to talk about APR. You know, what's whether it's APR is important, then we can try to.
Yes, absolutely. APR. Well, let me jump forward. APR, as we all know, is the total closing cost of a loan. Okay, closing costs including the points, the lender fees, the interest charges over the life of the loan. Now, so if you're getting a 30-year fixed loan, so that means all the charges over 30 years. Okay, that's the typical definition. So once you take all of the costs over that 30-year period, and then you sort of calculate backwards and trying to find the intrinsic interest rates on the loan, that becomes your APR. Okay. Now, personally, I will never shop a loan with APR. Okay. There are many reasons for that. Okay. First of all, most lenders, they don't calculate APR with the same definition. Some of the lenders, they don't include third-party costs in their APR calculations. Things like appraisal charges, mortgage insurances, they don't include that in the APRs that they disclose to you. Okay, some other lenders, they do. So if you're just comparing APRs from lenders to lender, you're not comparing apples to apples. Okay. The other thing is, in the Bay Area, I would say probably 70%, 80% of the loans that we do are ARM loans. You know, 7-year ARMs, 10-year ARMs, where the interest rate's fixed for the first 7, 10 years. Okay, for those kind of loans, they're still 30-year loans. Okay, it's just that interest rate's only fixed for the first initial periods, right? So to calculate APRs for those kind of loans, lenders usually, they have to project the interest rate movements after the fixed period is over. A lot of lenders, they have different projections, so therefore they have different APRs for those kind of loan products. Okay.
So in my understanding, I think instead of doing APRs, sometimes I think it's probably better to understand how much is really your interest rate, your actual interest rate you're paying mortgage on, plus how much is your closing costs. So that'll be the combination will be easier to understand than just understand one number as APR.
Correct. Now, if you look at, in the case of refinancing, almost 90% of the loans that we do, 90% of the loans we do is no point, no fee. Okay, so in theory, if you're not paying for any closing cost, then the mortgage APR should be the same as the interest rate on your loan. Okay, but you know, when I'm shopping for a mortgage, I just go straight to the interest rate and I tell the lender I don't want to pay any closing costs, not a dollar. So this way it's easier for me to get the interest rates from different lenders and then compare. If I have one lender telling me here's my rate, but there's some closing cost to it, and then you have another lender that have a different rate with different closing costs, then it makes it almost impossible for me to compare APRs. Okay.
Okay.
Go ahead.
No, I'm thinking that this is a pretty good information, so maybe you can save some of the information for questions and answers later.
Yes.
Yeah.
Well, one most important point I want to mention on this slide is that the official APR calculation is based on all of the closing costs over the term of the loan. Okay. For most of the mortgages, people pay off the loans, say every 3 to 5 years. Okay. So if that's the case, the APR calculation, official APR definition is not an accurate way to price the loan, basically. And for you to pay a lot of upfront costs like points and closing costs to get a very low rate on a loan, and if you pay off the loan in a very short time frame, say 2 years or 3 years down the road, then your APR, the real APR that you actually get, could be much, much, much higher than what's disclosed on the loan disclosures.
Okay.
So you need to be real careful with that.
So for the time being, maybe we can save for the rest of the information for questions and answers, and we can move on to our next speaker.
Yes.
Yeah.
Yes, absolutely. Okay.
Okay.
All right. So the next slide that I have is about discount points. So I just wanted to show you, as somebody who's in the business, how I will calculate discount points and whether, how I make decisions on whether discount points is worth it. So on the concept of discount points, I think that it's very important for you to understand what a par rate is first. Okay. Par rate is basically the standard rate for a loan officer that has the lowest points or no points and no lender credits. So it's just a plain vanilla rate. Okay. And for the for a customer that's thinking about getting a quote on a mortgage, okay, you can actually get a quote for as low of a rate as possible below the par rate, but the lower the rate and the further you move away from the par rate, the more points you have to pay. And every point is 1% of your loan, okay? And vice versa, you can say, hey, I don't want to pay any points and I don't want to pay any closing costs either. Well, the closing costs are not going to go away. Somebody's got to pay for it. So that means the bank is going to have to pay for your closing costs with some sort of lender credits. Well, where are the lender credits going to come from? They're coming from your interest rates. They're coming from the negative points that are attached to the interest rates. So the higher the interest rate that you have above the par rate, the more negative points that you get and the more lender credits you can get. Okay, so basically as a loan officer, for me to structure a no point, no fee refinancing for customers, I have to sort of calculate the closing costs backwards and then figure out what kind of rates I can get that would have enough credits in order for me to make that work.
Okay, Wilson, I think I see Larry coming to the meeting room. So
Okay.
maybe we can introduce Larry and then we can move forward with our next speaker. And before we move on to the next speaker, do you want to unshare your thing for now? Yeah.
Okay, go ahead, please.
Thank you, Thank you for your information. Can you unshare your screen maybe?
Oh, yeah.
Larry, I saw you come into the meeting room just now.
I am here, yes.
Oh, wonderful. Hi, Larry. So before we move on to our next speaker, I wanted to introduce you to a special guest today, which will be our speaker, our honor speaker next in 2 weeks. So we're going to continue our Buyers Are You Ready series for part 3. The following, in 2 weeks, we'll have this famous Santa Clara County Assessor Larry Stone joining us and give us a market update and also give us basically speaking about COVID-19, Silicon Valley's economy and real estate market. Larry, do you want to give us a very quick preview of what you'll be speaking about?
I would, and it'll be very quick. COVID-19 has ravaged the national economy. 6 months into the greatest crisis to face this nation since the Great Depression. I will talk in a couple of weeks about the economic health of each of the major real estate sectors, some of which are thriving and others are teetering on collapse. I will examine how the office, warehouse, retail, multifamily, and single-family housing sectors have performed, the prospects for their future, and implications for Silicon Valley. I will also discuss the COVID-19 triggered trends. Are they passing fans or here to stay, including their long-term implications on our local economy? So that's about it. I'm looking forward to the 15th, I think it is, that I'm going to speak. And at that time, I'll go into depth on these issues I just mentioned.
Sounds great to me. Yeah, thank you so much, Larry. Everyone, be sure to join us in 2 weeks, September 15th, from 5:30 to 6:30, and we'll hear this wonderful speech from Larry. Thank you.
Thank you. Thank you.
Yeah, great. Thank you. Have a good evening. So thank you, Wilson, for the valuable information. Sorry for the interruption, but that's great information, and we save more time for our questions and answers later on. So as we just discussed, credit scores plays a really critical role in the pre-approval process and also securing a good interest rate. Credit scores range from 300 to 850. Many of us always been wondering, Who is actually controlling or determining the score that is actually affecting our financing? What can we do to make it better? Luckily, our next speaker is an expert in credit management. His name is Ken Strey, and he's the CEO of Scorewell Incorporated. Ken is a leading expert on credit, its challenges, restoration, and coaching. He has spoken and coached with top real estate and mortgage professionals to improve borrowers' credit scores quickly. Ken specializes in credit and the Fair Credit Reporting Act law, credit restoration, and credit coaching. His clients include some very high-profile individuals living in the San Francisco Bay Area. Welcome, Ken, to our Zoom seminar.
Hi, how are you? Can you hear me okay?
Hi. Good. Thank you. Thank you for joining us. We really appreciate you sharing with us your expertise. Many people usually ever look at the credit score profile only when they are making a big purchase. Someone in your profession would probably highly recommend that we all be more proactive when we're dealing with our credit.
Yes.
Maybe you can give us started off by elaborating how the credit scores are calculated, which is always a bit confusing for a lot of people.
Very good. So, can you hear me okay?
Yes.
Okay, very good. So, yeah, the confusion that I deal with on a daily basis is probably the mystery of where scores come from. And just the short story is that we as consumers have access to the consumer models of credit. This is either by something that your credit card company gives you. Credit Karma uses what's called the Vantage scoring model. And most of the consumer type sites use the Vantage scoring model. It is a good model, but it's a little bit not as strict as the official FICO scores that the banks use. You may have wondered, when you buy a car, you get a certain credit score. When you apply for a credit card, you get a different one. And then lo and behold, when you apply for a mortgage, you get a different score as well. So the mystery is the fact that credit is very, very big business. And all of the credit bureaus are selling different products to different types of businesses to generate. It's basically called a risk-based scoring model. How likely are you to default? And they look at a lot of different parameters. But again, the short story is that you want to make sure that you understand what your mortgage score is. And if perchance you were looking at a Vantage scoring model, which is, most people know what Credit Karma is. And if you show an 800 on Credit Karma, your mortgage score would not most likely be that high. It might be 60, 50 points lower than that. And it could be even lower because, again, they analyze behaviors differently than the more stricter version that a mortgage company would pull. And basically, there's two things that I encourage people to focus on. Number one is having a good credit foundation. A good credit foundation has to do with maybe having at least one, but preferably 2 or 3 credit cards. You want to have them for many years. Length of time is very important. You want decent sized credit limits. You don't have to max the cards out. Actually, you only need to use your cards at least once every 5 months to keep them active. But for good credit score increases, you want to keep your balances below 30% of the credit limit. So having a mortgage, having a couple credit cards, having a student loan, having a vehicle, these are all good credit mix items. And again, the longer you have this mix, the higher your score can go. And then the offset to having a good foundation is damage. And damage comes in so many different levels. It can be a late payment that was 3 years ago. It could be a AT&T collection that you paid. Damage stays on your report for 7 years. So in a nutshell, my biggest advice to all of us is to make sure that you are monitoring, understanding your credit. Now, again, you can't get your official mortgage scores unless a bank pulls it. Again, Credit Karma is a good venue to see 2 of the 3 credit bureaus. If you contact Coco for my information, I will send you what I recommend. It is a very good 3 bureau report, and it gives awesome information. And like I mentioned to Coco, I don't know if she was going to highlight this, but based on my relationship with Coco, I am going to offer anyone on this presentation a free consultation. Typically, I spend about 30 minutes, do it over the phone or a Zoom type meeting, but generally it's over the phone. And my only requirement is that I do have a credit report, because then I can teach you very simply how to understand your particular profile, the things that you can do, and to improve your credit scores. And then if there is damage, we can look at options to correct those. Probably the biggest issue when someone goes to buy a house is, they decide they're going to buy a house, they go looking, and then all of a sudden they get connected with a mortgage loan officer. Then the mortgage loan officer pulls a report, and then they find out about their credit. So I guess I'm encourage you to be proactive rather than reactive. Know where you stand, know what your scores are, and know what the potential is. And like Wilson was given examples of different loans and interest rates. And when you're looking at loans over 800,000, you're in the jumbo category, and you need to have high credit scores. You need to be above 720, above 740. So again, it's real important to know where you're at, or else those dreams are going to go away. So again, Coco has my information. There's so much that I can explain one-on-one if someone has questions. Someone chatted about inquiries. You can do multiple mortgage inquiries in a 30-day window, and they only count as one inquiry. There's different tips on which credit cards to pay down to maximize your credit score. And again, it all starts with, let's take a look at your credit profile. And, I'd love to offer a no-charge consultation to help you understand that. So Coco, is there anything specific you want me to highlight?
Yeah, this is actually very valuable information. Thank you so much, Ken. I already see several questions. Today, we're actually streaming live on Facebook, YouTube, and other platforms. We actually have compiled some questions that our viewers have for our guests, for Ken and Wilson. Before we get into the question and answer session, I actually like to mention one more time, today we have a drawing. Annette Kalik from First American Home Warranty and JCP LPS Disclosures is our proud sponsor of my Zoom seminars. Today, our lucky winner will walk away with a insulated picnic basket. So please use the Google form for the entry. It's posted in the general chat in the Zoom. We will end the registration in the next 5 minutes so that my staff will have enough time to enter your names in a wheel of names and get ready for the drawing at the end of today's seminar. So 5 more minutes, we'll close out the registration. not sure whether Annette is online, but maybe Annette can be online to help us spin the wheel. So let's get into the question and answers. I think I saw some questions for Ken. Can you mention about the hit for the mortgage inquiry within 30 days? But is it 30 days or 45 days? Is any time limit for the credit check when you're shopping for a mortgage?
So yeah, the general answer is everyone says 30 days, but in actual answer, it is 45 days, meaning that if you are doing a mortgage inquiry, you can do multiples 2, 3, 4, 5 in a 45-day period, and the inquiry loss points would only be calculated as 1. In comparison, if you were to try to open up 5 credit cards, you would get 5 individual inquiries. And an inquiry, depending on where your score is, it can be anywhere from 5 to 8 point loss.
Okay. Okay. And then also there's a question I saw you answer, but I'm going to read it out anyways. So it says, hi Ken, why are my Vantage scores between EQ, TU, and Experian, okay, all different? Do lenders pull all bureaus and pick the lowest or highest one? Does Vantage equals to FICO? Why or why not?
Well, when a lender is pulling your score, they are pulling all 3 credit bureaus, and they use what's called the mid score, which they take the highest and the lowest, and they set those aside, and they use the middle of the 3. So if you had a 500, a 600, and a 700, which they wouldn't vary that much, but the middle of the 3 would be 600. And again, it's important to realize that we as consumers really don't have access to the lender scoring versions. There is one caveat to that. myfico.com does provide those scores, but they are fairly expensive to get. But we as consumers can purchase those, but it's about $40.
Okay. Yeah, so the next question is, hi Wilson and Ken, if I'm interested in buying a home in the next 6 to 9 months, what are the pros and cons in getting a pre-approved now? Example, if I have a hard pull now impacting my score, then another hard pull later on when I'm ready to buy will be a lower score, would my score recover by that hard inquiry after 6 months?
I think I'll take that. I think the most important thing is just to understand that for Bank of America, if we pull your credit report right now, it's good for 120 days. So what that means is that from the day that we pull your credit report to the day your loan closes, all of that has to happen within a 120-day period. So if for some reason, if you say you want to go buy a house, and we pull your credit report, you have 3 months to find a house, to go into contract, and then leave us another 30 days to process your loan and close the loan. Okay. So if for some reason you don't find a house until that 120-day period is almost up, then it's possible that halfway through your contract period, we will have to re-pull your credit in order for us to close your loan. Now, we typically prefer not to do that, because if we have to pull your credit report again, there could be some surprises in there, and your credit score could potentially drop, and it cause your interest rate to go up, and then cause qualification issues for you. So typically before I actually start the loan process, I will check the date of your credit report. If it's going to expire anytime soon or before the closing of your loan, then I will let you know, and then get your permission and re-pull your credit before I actually start the loan process.
Okay. So Ken, what do you think, would that score recover in 6 months if the pre-approval?
Definitely. The impact to your score is only for 90 days. So inquiries stay on your report for 2 years, but they only impact your score for 90 days.
So it's a good idea to start early. At least you know what to prepare, and then by the time you're really ready to buy, you actually your score doesn't get impacted. At the same time, you are more ready than before. Yeah. Okay, great. So another question: do lenders consider experience boosts or ultra FICO non-trade line scores for underwriting a mortgage, or is that only for subprime products? I think that's actually a Wilson question. So do you consider a non-trade line score, maybe like utilities, right? Like you pay in PG&E bill or things like that?
We don't. For most of the loan products that we have these days, especially for jumbo loans, no, absolutely not. We don't do that. We used to do it. Not anymore.
I think lender guidelines changed before, maybe for a lot of conforming loans, not necessarily for subprime, but even for prime lenders. If you have very limited credit lines, especially for people maybe coming from foreign countries or a younger generation, they don't have as many trade lines. They can use utility bills and other non-traditional non-trade line credit as your part of your credit score, credit profile. Yeah. Next question is, hi Ken, how long would the collection of your credit history and will stay on your credit history, and how to get rid of that early? I was thinking of 3 years, as you said, 7 years to get rid of the collection history.
So there is 2 statutes of limitations that relate to a negative, and a negative is either a late payment, a tax lien, or a collection. And from the date of last activity, for example, if you had a Comcast default, when you first defaulted, whenever that period was, it will stay on your credit report for 7 years. The enforceability is 4 years, meaning if you have a default collection on your report, the creditor has 4 years where they can sue you. After that, they can't sue you, but it can stay on your report up to the 7 years. The older the collection is, I do have options to improve that or remove that. But generally, we start looking at a collection that's at least 2 years old. If it's 1 year, we're not going to delete that.
Right. Actually, even when the time of the 2009 times, the short sale or foreclosures, you will stay on your credit report for 7 years. But the short sale, they would allow you to start buying again, maybe in 2 years.
Yes.
Versus foreclosure will only allow you to start buying again in 7 years. Correct me if I'm wrong, Ken or Wilson.
Well, the guidelines have changed a lot. This would be a question for Wilson, as far as when they allow a mortgage or refinance after an event, whether it be a short sale or a foreclosure. Wilson?
Wilson, you still online? We'll wait for him to come back. I have one more thing is saying, Daniel, you have a long history of paying rent on time, which is great. I think they actually used to take those rent or PG&E bills as part of the credit. So I think now it's probably if you don't have enough credit lines, you have to start applying for credit cards. Is that correct, Ken? If you want to build up the trade lines.
Yeah, the Ultra FICO and the Experian Boost, these are products that Experian created, and they use their own scoring model to add these things on there and give you a boost, give you a higher score, which looks and feels good. But unfortunately, when we're talking about mortgages, the mortgage scoring models don't look at those. So yes, the key to high credit scores, as crazy as it seems, is you want to have 2 to 3 credit cards that you've had for at least 5 years. Again, you don't have to max them out. You don't have to use them all the time. You just need to use the cards at least once every 5 months to keep it active. But credit cards are a very powerful entry on your credit report.
Great. So Wilson, you back?
I'm back.
So yeah, regarding the guidelines for short sale and foreclosures, how soon can you start taking mortgage applications after that's on your record?
Typically, we have to wait for 7 years, and then you have to show.
So even for short sales?
Even for short sales, yeah. I mean, some of the programs they might allow after 4 years. If you have sort of like a history of reestablishing your credits, that might be okay. Sometimes you can file an exception for that. But I will say, to be safe, I usually tell the customers you have to wait for 7 years.
Okay. There's a question for you, Wilson. Can RSU get calculated as income?
Absolutely. We do that quite often, actually. In Bay Area, that's a very popular source of income. So what we do is we take your vesting history for all of the grants, and then we look at the vestings for the last 2 years versus the vestings that will be coming in for the future 3 years. Okay, so we calculate the average for the past 2 years and the average for the future 3 years, and whichever is lower, we take the lower of the two. Okay, now keep in mind, whatever vestings that you receive from your employers, if you don't sell the shares, we only take 70% of that. We don't give you 100% of it, because if you have those shares in stocks, the stock value could fluctuate, and that could potentially affect your income.
Okay. There's a question for you again, Wilson. What's the ideal loan amount per month if you compare your earnings? What's the ratio? What's the ideal? I guess the debt to income ratio.
That's a debt to income ratio issue. So typically what we do is we take a look at your gross income before any deductions for taxes, insurance, and for retirement accounts. Okay. So we take that gross figure, we compare that to your payments going out. So to car loans, minimum payments on credit cards, any mortgage that you might have, of course, the associated property taxes, insurance, and HOAs, they're related to that property. And then we basically just, compare the ratios. So the expenses should not exceed 43% of your gross income. That's
Got it. Okay.
Your borrowing power.
Okay. And then, Ken, there's a question about forbearance. Would forbearance actually affect the credit score?
Well, that's a very good question. And there is guidelines that have come out relating to that. Whether the lenders utilize them or not is unsure. But the short answer on forbearance is that if you go into a forbearance with late payments, you are going to see restrictions, whether it be you can't refinance, your score will drop, or some other type of issue. If you go into a forbearance agreement and you follow the forbearance agreement and you are not late, then you will be okay. You will not see a score ding.
Okay. It's almost like I remember back in 2009 when people were trying to do loan modification. If you don't default, you cannot get loan modification. You have to default in order to qualify for loan modification. So now you're saying forbearance actually would, you actually can qualify forbearance without default, right?
Exactly.
Okay. That makes sense. Yeah. Okay, I think it's time. Thank you so much for Wilson and Ken for your valuable information and your time. And it's time for us to do our drawing right now. Do we have Annette online?
I'm here.
Okay, hi Annette.
Hi everybody. Hi there. And I am out for a birthday celebration, so I apologize. I'm not professional here, but I am professional. Okay.
You're our proud sponsor of our real old name.
Yes, I can't wait. Now here's the gift. If you guys can see, this is the lovely insulated picnic basket.
Nice.
Can you guys see it? Okay, so are we ready? Stop that wheel.
No. I forgot my mask.
Uh-oh, it's not stopping. There we go.
Aaron, we have a winner.
Aaron!
Do we have Aaron here?
Yay!
Aaron, are you online? Okay, we don't have, if our winner is not online, we have to spin it again. Aaron,
Okay.
are you online? First call. Second call.
Uh-oh, let's see.
Okay, now let's do it again.
All righty, spin that wheel. Stop. Oh my goodness, it was almost Aaron again. Jack.
Line. Jack, are you online? Just speak if you're online. I think I see you.
Yes.
Okay, great. Okay, so we'll get Jack's
Awesome.
information. Okay, we will send the gift to Jack.
Thank you all.
Thank you, Annette. Thank you, everybody.
You're
Please
welcome.
make sure you join us in 2 weeks, September 15th, 5:30 to 6:30. And that's our County Assessor Larry Stone will give us a market update and also the COVID-19's impact for real estate market as well. So thank you so much, and I look forward to seeing everybody in 2 weeks.
Thank you.
Thank you.
Bye, guys.
Thank you. Bye.